So here we are again on the broadcast. Today we are talking about politics and stock markets, why politicians are welcomed in financial industry. If you ever thought of the correlation between political events happening and the correlation with the stock markets, this event is exactly for you. And if you want to go deeper, stay with us. Today we have two speakers, Kuga Iakov sitting next to me, and he is a senior professor at St. Petersburg School of Economics and Management faculty. And the second speaker is Michel Verlaine, being a professor at ICN Business School. So let us start.
Okay, thank you for inviting me at this event, and thank you for attending this session. I'm going to talk about linkages between political events and stock market fluctuations and other economic market fluctuations. Of course, I'm not going to discuss every or many aspects, but I'll try to show several simple examples. And first of all, we need some framework to analyze these linkages. So let's start. I am going to discuss link from political events to stock market, not vice versa. We have two important concepts here. The first is following. Stock market is a market for shares of firms. And we need to know prices of these shares and what affects prices of these shares. And okay, there is a complicated discipline, asset pricing, which studies all these factors that affect market share, share prices, excuse me, but let's think about the first and the most important factor. This is a discounted cash flow to equity holders, equity owners. So how much of cash generates firm and at which point of time? And of course we prefer cash now rather than cash later. And as example, if political event affects cash flow, it leads to higher cash flow or lower cash flow, it affects prices of firms. There is another very important effect that political event can affect discount rate, that is how high we value cash later comparatively to cash now. But I wouldn't like to discuss this, though it's probably important too. And the next thing, next major concept is effective market hypothesis. The idea is that all available information on the market is in prices, is the price has affected prices of stocks, of shares, because otherwise there is a arbitrage possibility. That is, it's easy to sell something which is overvalued and to buy something undervalued, and to gain profit from other people, of course. It's a redistributive thing. So we need to check when the information about that of this event, that of this political action or something else comes to the market, earlier or later. And our basic framework is that a political event affects prices of stocks as soon as information comes to the market, and as large as it affects cash flow, expected cash flow. And I like to discuss two stories. One of them is about oil market and oil companies, which is quite important for Russia. And another one is Brexit and financial companies. And okay, very simple idea about oil market. We have oil price, and we have costs of producing oil, which is denoted as average variable costs. These are costs that are not that are linked to quantity of oil which is produced by companies, and what remains and what shareholders receive is a margin. It's profit from producing and selling 1 barrel of oil. And we see that if oil price goes up by 1%, the margin goes up by more than 1%, because variable costs are constant and margin grows. So now we may complicate the situation a little bit, because typically some costs are fixed, and here it means that some costs are not linked to volume of production of oil, and this ameliorates the effect. This means that profit reacts on oil prices even stronger than the margin. And third thing, which is very important and very specific for oil market, is that supply and demand are very non-elastic in a short run, which means that when we are thinking about months, production of oil is reacts weakly on growth of prices, and the demand for oil is also reacts very weakly, and it's quite wonderful, and even more wonderful that the situation completely changed in the long run, say when we think about years. Another element of the framework is event analysis, which I'll try to show to you in a very simple form. The idea is that, okay, we have a specific time, moment of time, and let's draw a time window which covers several days after the event and several days before the event, and let's analyze the changes, assuming that maybe no important factors affect our interest in variables, say prices of stocks. at this moment, or we may complicate the analysis and to account for some other factors within the window. And we have a choice. Too wide window means that more other events are within the window, and too narrow window may affect, may result that not all effects related to event would be considered here. So now let's go to the events. And the first one is a very simple one, is a civil war in Libya. Libya produced something like 2% of world oil production. So it's not a very large oil producer. The civil war started in 2011, and this affected production. Let's look at the date, concrete date, February 17, and let's think that civil war is not something which happens in one moment. It's a longer process, yes. It started on February 17, and this led to dropping of production by 3/4 at that year, 2011, and by half on consecutive years, and the civil war continues till now. And let's see what happened here with oil price and major stock indexes, Standard & Poor's 500, and three largest Western oil companies, that is British Petroleum, Exxon, and Royal Dutch Shell. And we see that oil prices rocketed by about 12 to 20%, while stocks of oil companies and other companies were quite stable. So we see that expected revenue in these years went up, but overall cash flow was expected as quite stable. And how it's happened? I'm not too quick here. Okay. How this happened? Because first of all, investors very quickly within just 1 second. The complete window, width of window is 41 days, 20 days before the event, 20 days after event, and the day of event. And we see that most of reaction happened in 3 days. So investors realized the consequences of this civil war very quickly. And these consequences are huge for oil prices and not so high for stock market prices, because companies think about future of oil markets. They know that in longer run, elasticity both of demand and supply are not so low, and oil producers may think about finding new basins, for example, shale oil in this period, and consumers may think about green energy or electric cars and so on, and these higher price wouldn't last for a long period. And they knew this, maybe not preciously, and result was quite small. What about time? Okay. Well, the next event is a breakdown of OPEC Plus cartel last year. This happened on March 5, and you may remember, if the audience is Russian, you may remember this event when exchange rates of dollar or euro raised significantly at the early 2020. And the story was following. OPEC Plus reduced production of oil by about was reducing production of oil by about 2.1 million barrels per day. That is about 2% of oil production. We know from the previous example that it is quite significant effect, but not so much. And the Russian share was 300,000 barrels per day. And it's really small, even if we take into account for our previous example. But the result was huge. Brent prices dropped by more than 30% in 2 days. And okay, stock market was not so sensitive to this event again, but on another hand, it was more sensitive. Well, so this again shows that from our oil study, when we discussed profit of oil companies, we see that stock market should react stronger than oil market. But in fact, we see the opposite thing, and this means that investors think about long-term consequences, and they discount these long-term consequences. They think that situation would normalize later, and so on. Okay, I'll skip the third event. It's exactly the opposite event. And the fourth event is the Brexit referendum. There was a referendum about United Kingdom's exit from European Union. It's happened in 2016. It was relatively, the results of the referendum were unexpected. This referendum, okay, the whole Brexit process led to a situation when it became more difficult for United Kingdom to trade with Europe, and the Europe is very large and a very close market, and the trade with close trade partners is more intensive. And as a result, this may affect exchange rates and British pound exchange rate. There are some ideas that the effect should be positive, and there are some ideas that the effect should be negative. And okay, now we know that negative effect is much stronger, and we see that British pound depreciated by something like 7% in 2 days. And it's a black line on the graph, and financial companies and stock markets react in different way. Green line is the insurance company Lloyd's, and there are Barclays Bank and HSBC Bank. These are largest UK banks, and the idea that banks are very Oh, okay, maybe I'm wrong here. The idea that banks react in different way, but the trend is common. The effect of this event is common. It's negative, and Michel Verlaine would show you why it is so negative. I'll think that I wouldn't discuss this later because Michel Verlaine will put it into his context, I think, much better. So I think that we should conclude, and the idea that political events provide new information on the markets. They provide this information very quickly. Investors foresee consequences of this event. We know that Brexit have not finished yet, and financial markets are still linked, not as if there were no Brexit at all, but still linked more than it is natural for European Union and independent country like, I don't know, Norway. But most of reaction happened in 2 days after the result on the referendum. And we can trace the mechanism how these political events lead to this change on stock market, other markets like oil market, and so on. Well, and thank you for your attention.
So yeah, now we will switch to the Professor Verlaine.
Hello.
Hello, I can hear you.
So after the focus on the stock markets, very interesting focus. So I'm going to speak more about the, I would say, structural issues relating to geopolitics. So I speak about geopolitics of the architect and the architecture of the asset management industry, which is actually a subfield of a new topic we are developing called geopolitics of finance. Or basically, so what I call the architecture of finance is basically analyzing the different structures of the financial sector, because the financial sector is much more complex than what is often disclosed in most finance books. And very often it goes together with actually relaxation of rationality, means a field called behavioral finance, because people are not totally rational, and so the financial sector oversells financial products to basically complex financial structures. So basically here I'm focusing on the asset management industry, which is actually one of our strengths. And I'm going to elaborate on that because the asset management industry is basically based in Luxembourg mostly, from where I am. So I somehow specialized on that. So if we focus basically now, well, I call it the architect of the asset management industry, but it's also in the US, it would be like characterizing what the mutual fund environment is about. Well, basically you have investors first, they are the shareholders basically of the legal structure, which is the fund. And of course you have a board of directors, and then you have the investment fund. And people basically, well, most the literature is not focusing that much. What is it? I got a chat here. Okay. Is not focusing that much on these players that are here, which are basically the service providers of the fund industry. And actually they are where the jobs are located. And most actually books focus, if you look at books of investments, on portfolio theory, which is actually how to invest and which method to use to invest. So let's focus on these 5-6 blocks. Well, I use the American way to characterize it, but I would change it a little bit, typically because this management company is basically the business structure that is managing the investment fund. So it's very important to understand that this investment fund is one legal structure, and this management company is another legal structure that is actually managing this fund. And actually, if you look at the Europe or the European Union, most of these funds here are located in Luxembourg. This is the second market after the US. But most of these management companies, they were located in the UK, actually, before the Brexit. On the post-Brexit area, there will be relocations. So this is why I'm elaborating on that. However, also very important, this is called the ManCo typically, a shorter word for management company. And actually, in general, well, we could picture it like this, that basically it integrates some of these activities, not all of them. But this management company that manages this fund could actually be investment advisor. So that's the brain that determines the investment strategy. It could also do the accounting. It could also be distributor, which means the unit that is selling the investment fund, or also transfer agent, which is actually calculating how much the investor gets. So these are all functions that don't look like important at the first moment, but they are needed to create the business actually. Okay, and those that have done some finance will agree with me that in most of the books you have just portfolio theory and optimization, but not much focus on that. This structure here, which is the custodian, as actually also called a depository bank, needs to be independent of this management company because it's actually keeping the assets safe. So the idea is that the structure that keeps the assets cannot be the same person than those that are managing the fund, actually, because otherwise they could steal the assets, move away with the assets. So that's basically this architecture and the players that you have around. There are corporate governance issues also here that are very specific to the fund industry. For instance, these shareholders here, they can shift on a daily basis for an investment fund, which is not the case for a bank or for a standard corporation, for instance. Okay, so now I've understood that, well, I was maybe expecting some interaction, but basically, typically what I ask in face-to-face exchanges is now, what if you take these five service providers, which means the lawyers that create the structures and that help you be compliant, the administration, fund administration, client administration, which is basically the accounting and the auditing. Here you have the formal asset management, which means the strategy, where the strategy is determined, the custodian who keeps the asset and distribution. Well, typically, if you had a moment, but you can do it for yourself, think about if you had an investment fund, for instance, that would charge, let's say, 1 million euro, okay? That would be typically investment fund that manages 100 million euro. So it would take 1% of 100 million of fees. So if you have 1 million here, how would it be split, according to your opinion, between these different service providers? Now, I can give you the answer that I expect and that I've seen very often. And actually, it's very funny, even in the Luxembourgish market with professionals, very often the answer is not really correct, because most people have, even working in the industry, they have a narrow view on their task and not necessarily on the whole picture of this. So basically, most people actually suppose that the asset manager, who is supposed to be like determining the strategy, takes most of the fees, I don't know, 30-40%. And then the custodian takes a little bit, maybe administration takes a little bit more, like 20%. Here people put 15%, and these two lawyers and custody are very, very low. Okay. So now, if we move to the data now, well, I hope it's visible. You see here what we call, you see already, I use an industrial view of the asset management industry. It means like we have total production costs of typically equity funds. Equity funds mean standard shares on the market. So if you look at this, very interesting, and this is where the geopolitical component comes in now. even though for the moment it's focused on the European Union here, you have basically the costs in terms of basis points of investment funds in the EU for different countries. So you have here 60 basis points, which is 0.6%. Here you have nearly 1%. So, and you see here, actually, first, what you see is there's the yellow part here, but I focus on the biggest block, which is fund accounting, is actually as important for most countries than the asset management, okay? So in terms of cost for the fund, it's equivalent actually. And then you have regulatory compliance is also not so high, but relatively important. So here you have basically the two most building blocks are actually asset management and administration. Another interesting fact that you see here, well, first of all, Luxembourg is the main market, but it's not that cheap. But that is because there are skills that are very adapted to the fund industry and very reactive that are not necessarily just linked to the cost of the manufacturing of the fund. And here you have something interesting. If you look at Poland, for instance, Poland here has for the transfer agency, and transfer agency is the one person that calculates how much the investor will get. With new technology, it's also getting less and less important. But you see that the cost is actually completely higher than, and it makes actually the Polish market completely non-interesting for investors to set up investment funds. Well, and that's actually because there is a data protection law that is very strict apparently, and that boosts these costs here. See, you see, and that is why I'm speaking about that, is because that, as an example, whether it would be Poland or another country, this is a layer where if you're a political decision maker actually could use that data to analyze how to actually slash that cost here. Okay. So so that's what we call the total production cost for the equity, but it's not the whole cost. And now we get to the more interesting point even, is basically now I add on top of that, we add on top of that distribution costs. Distribution costs is the sales of the fund. And actually that's interesting, most people forget it, but the sales are the most important actually in the fund, in many businesses actually, the branding and the sales. So if you add on top, you see here, now I keep here asset management, administration general of the fund, and the regulatory part. We know it's a little bit synthesized. But you see clearly that actually 70% in most of the cases are distribution costs, okay? And this is actually what I'm saying very often to my students. You know, sales is actually more important than the asset management in itself. And it goes also together with the structure, the platforms that you can use to sell. And actually, that's an interesting point because the new fintech platforms and crowdfunding and peer-to-peer platforms are going to have a huge impact potentially on this industry, at least what I expect. So, okay, so you see this, well, this is, how to say, you understand how the geopolitical implication of these different cost structures and why analyzing and zooming in on detail is important if we focus here on the asset management industry. And it's also important to realize that more and more in the future, the industry, actually, this is a project called the Capital Market Union in the European Union. The industry is moving more to financial markets and investment fund financing rather than banking, because it's more efficient, cheaper to finance. So if the investment is cheaper, basically when the financing is less costly, you get more economic growth in the long run. So this is why the European Union is pushing for that and creates this market of supposedly, well, relatively efficient investment funds. Now also, another dimension of the fund is, you see here, fund costs go down with the size, which means also that there is principally what's natural, the fund industry has from the cost side, a natural monopoly, basically. It means that bigger funds are actually more efficient, well, less costly than shorter funds. The bigger the fund, the less costly it is. From the asset side, still, there is also the negative effect that if you are too big, it's difficult to generate outperformance. So actually the performance goes down. At some point, you get an equilibrium in the industry where performance is, cutting with the down costs going down at some level of size. So here you have a few graphs, and you see also that equity, the more complex the fund, the more higher the cost, especially at the beginning. So this is also going to determine the size of the fund, because at some point, if you think about the cost, here you are too costly, but at some point you get competitive. Yeah. You see here you are with 60 basis points nearly on the equity cost, but this is just the accounting. It's much too high. So you actually, for I give you the in Luxembourgish market is about 20, 30 million euros before you get competitive. It's, well, how to say, useful to create an investment fund for investors, shareholders. So you have this, you see for most of them here, this same here, it's even more clean, how it goes down and how it is related to the different kinds of funds actually, okay? So if I move now, also the next dimension, one dimension is across countries. Uh, and then the next dimension would be, if you think in terms like a matrix, what kinds of funds could potentially be attracted to which kind of territory. And that will depend on the cost structure of the fund and the different parts. So that would be the second layer that basically I have is here. So I analyze here money market funds, which are the cheapest ones, because they are basically typically non-risky, principally no risk at all. So the management is less costly, and especially if you see here, the asset management is very uncostly compared to that. So here you have bonds, the asset management more costly, equity as well, because there is more active management. And uh, and the regulatory part is more or less the same. So basically, but that's going to condition. Remember, if you go back in the presentation beginning, where the management company might be localized, because the management company is actually this component here, which can be localized in different countries with new regulation. So at the beginning, the asset management company and the fund had to be more closely, or some activities closely linked. With new regulation in the EU, they can be dispersed to different markets. So there is a strategy of localizing part of this activity in different areas. So I'm going to be fast here. The next layer that you have, so is basically that you have different types of asset management firms. Some are actually asset management firms for larger groups. I don't know. I suppose in Russia would be like Sberbank having an asset management arm, which is a big group. Others are private banks. The private banks are more like creating products, but not so active asset management. And then you have independent, smaller asset management firms and independent boutiques. So these are typically small. I give you an example: firms that would be, how to say, specialized in investment in wine, for instance. Okay, it's not necessarily stock market, but in very specific wine, it exists. So these are typically smaller firms with a very specific investment strategy. And then you have universal providers of back offices. That would be actually a model where there is no active asset management, investment advisory, but there is all the accounting, the administration, the regulatory advice, and so on is provided for typically these asset management boutiques that don't have that part. Okay. And then you have, independent advisors that are basically just on the selling part. These are basically just in the distribution part. So if you allow me to go back, basically this is a splitting of these components here. Some are doing just this, some are doing just this, some are doing distribution and independent accounting and transfer agency. Yes, and that's what these business models are now. Now, to close this discussion, you understand, so basically, when I speak, there are geopolitical implications of this because this investment universe is getting more and more important. As I said, with the Brexit, a lot of this industry is relocalizing around Luxembourg and Frankfurt, basically. And this is due to the usage rule, because there are actual regulations that if you're in the EU, you have a passport. Passport means you can open an investment fund in all the member states, and you can also open a management company in different member states as you like. But the problem is with the Brexit, the British are losing this passport. So they are obliged basically to set up structures in Luxembourg and Frankfurt. Otherwise, they couldn't distribute these funds in the EU. So the next step, well, follow up of this is that basically in the EU, but not only in the EU, this is a trend that's going to be, I think, international. Governments can compete to attract these investment funds with specific strategies and specific policies to attract them. Okay, as this trend in general is towards more financing to investment fund than banks because it's cheaper, I think this is going to come also in the CIS market and in Russia, where the density of the industry is actually still much lower, actually. So I think, well, that's also the conclusion. I think this is an interesting topic. Well, actually, to make comparative research as well, comparing the asset management industry, maybe in the CIS Russian market to the EU, and to think about modernization of the asset management regulation to foster economic development. Well, I'm actually done, I would say.
So, yeah, while we are done, we have only one question. Do you, dear professors, have some book recommendations which can be useful for people that want to master their skills in analyzing political situations and their correlation with financial situations?
Some books?
Yeah, some books.
Well, I was speaking more about structural issues. I have actually a book, I'm not saying it's big, but written on that kind of stuff, and a paper on that concerning geopolitical. I know papers, research papers. I have also students working on that. Well, actually, the topic that was mentioned by Professor Kuga, basically that's the second part of the geopolitical finance topics we are developing, which is actually market reactions towards financial events. And you can use actually financial derivative products to isolate much more this kind of events, okay? So, and there are papers from the Journal of Finance, so I don't know of any book on that, but I mean, there are papers out that address at least partly this kind of issue. I think.
Maybe you have some?
No. Well, I agree that most of specific questions are usually studied in papers, not in books. But okay, first of all, there is pretty old macroeconomics textbook by Jeffrey Sachs and Lauren. I don't remember his name, F. Lauren, and this is translated into Russian if anybody interested. So you can read this or try to choose another macroeconomic textbook which is related to international issues, for example, macroeconomics European text by Burda Whiplash or something like that. And when you think about financial markets, for example, I like very much Fabot's textbook on fixed income instruments. And that is mostly bonds, and you can choose some insights which are related to political events too there.
And the next question to you. So maybe you can mention some skills and knowledge that can be applicable for analyzing the correlation between these political situations and financial markets.
Okay. Well, when we talk about financial markets in this way, this involves time series, and hence here we have time series econometrics of other kind. But this is not a single approach to analyzing markets. When you think about a question why the same political event affects different assets in prices of these assets in different way, then you may think about other methods. Yes, but in a way I told about, okay, it's time series and time series econometrics, and you can say about event analysis, and of course event analysis I demonstrated is very simple, and to make good quantitative estimates you need much more sophisticated approaches to event analysis. So the discipline is the same, but the concrete methods are more complicated.
Okay. So, dear professors, thank you for your answers and for your beautiful presentations. I hope this information will be useful for our viewers. Ну, а на этом наше мероприятие подошло к концу. Надеемся через 10 минут вас снова увидеть. И мы приглашаем вас на присоединение к нашей экспертной сессии по блокчейну. Криптовалюты и блокчейн. Как построить карьеру в новой индустрии с Алексеем Антоновым.